Hi, welcome back. About a week and a half ago, I valued Zomato ahead of its market debut and arrived at a value of about 41 rupees per share. And I heard from a lot of you, especially after the market opened up almost 3 times higher than my value. And I heard from two sides. On the one side, I heard from people saying, hey, how come you're giving such a high value to a company that's never made money? Convinced that I was being far too generous in my assumptions about future growth and market share and profits. I also heard from far more of you saying that I was missing something. Obviously, I had to because the value was so much lower than the price. You pointed to the potential the company had to enter new markets, cloud kitchens, grocery deliveries, and you argued that perhaps I was missing some element of the cash flows getting too low a value. Some of you even argued that there's no point valuing a company like Zomato in a market where everything is being driven by mood and momentum. In this post, I'd like to revisit my Zomato valuation. But rather than thrust my valuation down your throat, why would I want to do that? I'd like to give you a way of valuing Zomato on your own. Now don't get freaked out. You're saying, I've never valued a company. I'm going to do all of the dirty work. All you have to do is sit back and tell me your story about the company. So let's get started. So as I pointed out, I posted about 10 days ago valuing Zomato, and the post was carried in a number of different publications. And I'm grateful for that publicity. But there are a couple of these portrayals that I found a little unsettling. And there were two aspects of what they were saying about my post that I thought did not quite convey the message I wanted to. The first was many of these postings about my post started with the statement that I was some kind of a valuation guru, dean of valuation, you name it, that somehow I was above the crowd. The second was that my valuation was in some way a reflection of deep research, something that only I could do, complex thought. And both are far from the truth. In fact, there's nothing in valuation, nothing, that merits attaching the word guru or expert to somebody's name. Valuation at its core is basic. Anybody should be able to do it. And while valuation practitioners have shrouded the practice with mystery and premiums and acronyms, anybody should be able to do valuation, or at least that's what I believe. I know you don't believe me, but at the end of the session, maybe you'll rethink that proposition. So let me start with two things that I think came through from that post that I'd like to dispel because I don't think they're true. The first is that because I found Zomato to be overpriced, my value is so much lower than the price, that I don't like the company. Let me draw a contrast between a good company and a good investment. Now, when you sit down to value a company, you make projections about the future, about its future business model, the cash flows, the growth, the risk to value the company. If you have a good company, obviously, those expectations are going to be high. High cash flows, low risk, perhaps a high value. At the same time, the market is pricing the company based on investors' expectations of the future, as well as mood and momentum, other pricing factors. Whether a company is a good company or not depends on what you think about its business model, its cash flows, its growth or risk. Whether you think this company is a good investment depends on what your expectations are for the company relative to what the market expects the company to do. You're saying, what are you talking about? Let's take a company that you think is a great company. Because it's a great company, your cash flows are going to reflect it, right? You're going to have high margins, high earnings, high cash flows, high growth, perhaps low risk. But let's say the market also thinks that this company is a great company. You know what you're going to see? You're going to have a high value, you're going to have a high price. The company is not going to be a good investment even though it's a great company. At the other end of the spectrum, let's suppose you have a company that's a bad company. And those expectations come through, that the future is not going to be good, margins are going to be decreasing, revenues are shrinking. But let's say the market also believes it's going to be a bad company. Guess what? The value is going to be low, but so is the price. Investing is about finding mismatches between what your views of a company and what the market's view is. A good company to invest in is one where you think the future is going to be good for the company or even great, but the market doesn't think very much of the company. Conversely, an investment is bad if you don't think much of the company, but the market has sky-high expectations. Now, what do I think about Zomato? The story I told was, I thought, an upbeat story. But the market clearly has an even more upbeat story. I think it's a good company, but the market thinks it's a great company. That's what drives investing. Now, the other thing that some people seem to be suggesting came out of my post is I was trying to convince other people not to invest in Zomato. That's not my job. I do valuations for an audience of one. And that audience of one is a very forgiving, very understanding audience, because I look at that audience every day in the mirror. In other words, I do valuations for me. My story, my valuations drive my investment decisions, and I'm not being selfish. It reflects my view that for investing to be healthy, we all need to take ownership of our investment decisions. Put simply, you shouldn't be buying a stock because other people are buying it, even if those other people have reputations and are legendary investors. How many times have you told people, I heard people say, I'm buying that stock because Warren Buffett bought it. I'm not saying that Warren Buffett is not a great investor, but your decisions have to come from your assessment of value. So if you find Zomato to be cheap and buy it, who am I to talk you out of that decision? It's your money, and your decision should be driven by your assessment. Now, part of the reason I'm doing this session is to give you a way of making that assessment of value if you don't feel comfortable doing it. So let me lay out the steps in valuing a company. And these are steps I've developed before, I've talked about before. It's a 5-step process. In fact, I have an entire book on this process. But to value a company, you start with a story about the company. You stop and make sure in step 2 that that story is not a fairy tale, that it's possible. But in addition, it's also plausible and probable. I'll come back and draw the distinction in a little while. Third, you convert that story into numbers. And I try to keep my valuation simple so that I can convert my story into valuation inputs. And in step 4, valuation is mechanical. Once you have the inputs, the value does itself. But there is a step 5 that I want to talk about that I call the feedback loop, where once you're done with your valuation, you want to keep the process open for people to disagree with you, tell you what you've done wrong. And rather than get defensive, you want to take what they tell you and make your story better. Now, I'm a great believer in this feedback loop because I think it is what makes valuations healthier. I'm not suggesting that this is easy, because when you're done with your valuation, after all, it's your valuation. It would be unnatural not to like it. But you want to keep this feedback loop open. And there are 4 suggestions that I would make to you if you do valuation to keep this feedback loop open. First, talk to a diverse audience. We live in a world of specialists, especially in the last century and in the last few decades in particular. We've developed a world where people focus on a small slice of a small slice of a small slice of the world and learn everything there is to learn about it. And guess what? They often hang out with other specialists, they talk to each other, and after a while they forget that they're specialists. And in the process, they develop tunnel vision, where they know a great deal about a small piece of the world, but they can't step back and get the perspective. In other words, they've lost the forest for the trees. I'm lucky. I'm lucky in the sense that I get to interact with all kinds of people, with CEOs, with bankers, with, I've learned more about Uber talking to Uber drivers than I would ever learn from an Uber manager. Keep the process open to listening to people who think very differently from you. In other words, hang out with people who don't think like you. Second, in my valuation classes, I start with a statement that's enigmatic. People say, what are you talking about? I said, I'd rather be transparently wrong than opaquely right. We take the second part of it. What is opaquely right? You've all listened to market gurus who might tell you what's going to happen, but by the time they're done, you have no idea what they've told you, because they've gone on the one hand, on the other hand, on the third hand, they've covered themselves almost entirely no matter what happens. I don't believe in doing that. I'd prefer to take a stand, even if that stand is wrong. And I prefer to make it clear where I'm coming from in taking that stand. That's why all of my valuations, I've tried to be open about not just the mechanics, but the inputs. And I've left the spreadsheets open so that you can go in and change the things that you don't like. Pick transparency over opacity. Third, talk to people who disagree with you, but that's pointless if you're not going to listen to those people. There's almost every aspect of any company that you're valuing. There will be other people out there, perhaps not in finance, not in valuation, who will know a lot more about that piece of your company than you do. I wasn't kidding when I said I've learned more about Uber talking to Uber drivers than to analysts or Uber managers. After all, who is in a better position to tell you what Uber does well or badly than the drivers who make the company run? And finally, after listening, you got to be willing to change. I've told people again, and this is something that I truly believe, that the three most freeing words in investing in valuation are, I was wrong. It doesn't come easily to any of us, right? It doesn't come easily to me. But I have good news. The more you say it, the easier it becomes. I've been so wrong on so many companies that I've had to say this enough that it doesn't, it rolls off pretty easily now when I have to say it. And you know what? Once you say it, it frees you. It frees you to change your story and tell a different story. As long as you are unwilling to say those words, I was wrong, you can never revisit your valuations. So on Zomato, I got a great deal of feedback from you. First, I learned a great deal about food delivery in India. I don't live in India. I don't order food in India. And my exposure to Indian food delivery comes from talking to people in India. And I learned a great deal about food delivery in India, restaurants in India. I learned about why Zomato Pro is not caught on as quickly as the company thought it would, that maybe the discounts look better on paper than they are really in practice, why some of you prefer Swiggy and why there are regional differences. In fact, I even found out what you like to order from restaurants. Biryani must be an everyday occurrence now, unlike when I was growing up in India, because many of you seem to be ordering it on a daily basis. I did learn some things about India's tax rate. I'd used a 30% tax rate based on what I'd read in public spaces, but I was told the tax rate is only 25%. I confess that I went and read the section of the tax code. It's incredibly difficult to figure out what the corporate tax rate is in India, because India has these surcharges that are supposedly temporary but last forever, exceptions that left me completely confused. But you know what? You convinced me. I'll stay with the 25% tax rate, and that does raise my value from 41 rupees per share to about 43 rupees per share. But the biggest feedback I got was on my market. I'd focused Zomato in the Indian food delivery market, and the pushback I got was on multiple dimensions. One was, why am I not looking at the global food delivery market? Why just India? The second was, why just from restaurants? Why not from grocery stores and cloud kitchens? And the third was, why can't Zomato do other stuff with these restaurants, other businesses? Now, I think that it's going to be difficult for Zomato to replicate its success in India and the rest of the world for a simple reason. What makes Zomato so successful in India, those networking benefits, will start to work against it if it tries to enter the US market, the European market, or the Chinese market. I do think grocery delivery is a big market, but the slice of revenues you get to keep in the grocery delivery market is far, far smaller than the restaurant market. In the US, for instance, Instacart, which took off during COVID, found that its slice of revenues is 6, 7, 8%, not the 20 to 25% you see with restaurants. And even at those levels, grocery stores were pushing back. It's a very different, much lower margin business. I'm not suggesting there's no basis for these stories, but at least for the moment, I'm going to stick with my Indian food delivery story. So you ready? You're going to value Zomato. We're all going to collectively value Zomato. And here's what I'm going to do. I'm going to list the key inputs driving Zomato. I'm going to give you the choices that you can make. I'm going to tell you what choice I made, but not so that I can influence your choice, but to allow you to make your own choices. So let's start with the big one. What's the total accessible market? If you remember, in my base case, my Indian food delivery market was about 2,000 billion rupees by the end of the decade. That's about 25 billion. Now, I could be overshooting. Maybe the food delivery market in India will grow much more slowly than I think it will, which will be a function of both economic growth and how much Indians will move towards ordering food online. Maybe it'll be a $15 billion market, a smaller market. Or it could be faster. The growth could be faster. Maybe the food delivery market could be larger at 3,000 billion rupees. It's also entirely possible that the grocery delivery market becomes part of the overall food delivery market. It gives you a $5 trillion Indian rupee market. Or maybe you have a story that includes other markets, in which case you can enter your number. So I'm going to take a pause and let you pick. I've given you my choice. It's 2,000 billion Indian rupees. You can pick a bigger market or a smaller market depending on your view. Now, you also will get a chance to decide whether the growth is going to be front-loaded or spread out evenly over time. What do I mean by that? Let's say the eventual market is going to be about 2,000 billion Indian rupees. Now, whether you get there with higher growth in the first few years or even growth across time is a choice you can make. If you want to use the same compounded annual growth rate every year, enter a growth factor of 1. If you want growth rate in the first 5 years to be 1.5 times higher than the growth rate in the remaining time, put 1.5. In other words, the more growth you expect to see in the early years, the higher this number should be. So that takes care of the total market. Let's move on to market share. Again, reminder that in my story, I gave Zomato strong network benefits and a 40% market share. Again, I might be overestimating this market share. In my story, there are going to be 2, perhaps 3 big winners. Maybe you think there'll be 4 or 5 or 10 winners in the Indian market, in which case the market share is going to be far smaller, 10, maybe 20%. Or maybe Zomato is on its way to dominance, 60%. Yeah? And if you want to use some other market share, go ahead. That's the share of whatever market you picked in step 1. But let me caution you. The choice you make here will be affected by the choice you made about the total accessible market. If you chose the grocery and the restaurant delivery market as your total market, maybe you got to be a little more conservative about picking market share because it's going to be tougher to establish dominance or strong network effects. Let's move on to revenue slice. Remember that Zomato gets to keep only a portion of each gross order value. That number was about 21% in 2021, the fiscal year 2021. In my valuation, I used 22%, halfway between the 2021 and the 2020 numbers. But maybe I'm undershooting. Maybe Zomato will become a duopoly with maybe Swiggy or one other player, and they get to keep 25%. It'd be incredibly unfair if you ask me to restaurants, but could happen. Or maybe I'm overestimating that slice. Maybe Amazon Food will put enough pressure on the competition to lower that slice to 15 or perhaps even 10%. Again, your choice on whether the grocery delivery market is part of the total market might influence what you pick here, because the grocery delivery market, as I noted, you get a far smaller slice of the order. Now, once you get that slice of the order, you get to spend money out of that. Right now, the big expenses for Zomato are selling and SG&A expenses. And there are economies of scale that will kick in, which is one reason why I gave Zomato 35% margins. But maybe I'm underestimating the pricing power that Zomato will have, in which case the margins could be higher. Or maybe I am overestimating the economies of scale, in which case the benefits could be lower. In fact, if they have weak pricing power, no scaling benefits, then their margins could be 15%, not 35%. Again, make your pick. And if you think about the pathway to profitability, which is how quickly they will get to the target margin, because remember, they're losing money now, you can believe that this pathway to profitability would be extraordinarily smooth, in which case they get there in year 3. Maybe it'll be what I assumed in my base case, 5 years, or maybe this is going to be a lot more rocky than we thought it was, in which case you can pick 10 or pick a year that you think reflects what you think about the pathway to profitability. Which brings you to reinvestment. Growth requires that you reinvest money. Now with Zomato, that reinvestment will take the form of investments in technology and platforms, as well as acquisitions, because that's how they've historically grown. Now, in my base case valuation, I gave them, in the short term, the benefits of being able to bounce back from COVID hit revenues, which means at least in the near term, now the higher this number, this is the sales to capital number, reflects the dollars of revenue you get per dollar of capital invested, or rupee of capital invested. The higher this number, the more efficiently you're reinvesting. In my base case valuation, I assumed that in the near term, Zomato will be able to use bounce back growth, which requires much less investment. In fact, I gave them a sales to capital ratio of 5 in year 1. And then I lowered it over time to 2.5. That was my base case. Of course, I could be underestimating reinvestment, that the true reinvestment could be far greater. The tech company median is about 2. Capital intensive companies is about 1.5. So for those of you telling stories about Zomato entering more capital intensive businesses, your sales to capital ratio is reflected. Or maybe Zomato will find a way to coast where they can get $5, $10 of revenues for every dollar of growth, which will give them very little reinvestment. Now, my definition of reinvestment, it includes everything: working capital, what I call net capex, the difference between capital expenditures and depreciation, and acquisitions. So it's a composite number. Which brings me to risk. There are 2 parameters I use to capture risk. One is the cost of capital. The other is the risk of failure. The cost of capital reflects the operating risk of the company. The risk of failure reflects what I call truncation risk, the risk your company will not make it. Now, to get a sense of the cost of capital, I want to give you some perspective. Every year I compute cost of capital for every company in the world, including Indian companies. And I did this for all Indian companies in July of 2021. And I did a histogram. Remember in statistics what we do with histograms? They're very useful because they give you a sense of perspective. The median cost of capital, and this is in Indian rupees, so building off a risk-free rate of 4.25%. The median Indian company's cost of capital is about 11%. The 10th percentile is 8%. The 90th percentile is about 13%. Now, when I computed the cost of capital for Zomato, I came up with a cost of capital of 10.25%. I did a pretty elaborate dance of looking at what business they were in, measuring market risk, default spreads, cost of debt, cost of equity. I'll make a confession. In this valuation, the cost of capital is not even on my top 10 list of worries. And look at how much work you're putting in for a number where the range is so tight. 50% of Indian companies have cost of capital between 9.5% and 12.06%. 50%. So rather than go my route of trying to come up with a beta and a risk-free rate and a default spread, all those gyrations, I'm going to give you a much simpler way to think about the cost of capital. I've broken down Indian companies from lowest decile to the highest decile in terms of cost of capital. And I used a 10% failure risk. I'm going to let you pick what you think the cost of capital is for Zomato based on your assessment of risk. So if you think it's a very low risk company, give it an 8.01% cost of capital. That'll put it at the lowest decile. If you think it's low risk, 25th percentile, give it a 9.5% cost of capital. Conversely, if you think it's a very risky company, give it a 13% cost of capital. But if you think it's at the just high risk, not very high risk, give it a 12% cost of capital. If you want to directly input a cost of capital, remember it's an Indian rupee cost of capital. So be careful not to enter a number less than the risk-free rate. But I'm going to let you make the choice. On the failure probability, you get to decide. I think the chance of failure in Zomato is low, notwithstanding its money-losing, cash-burning status, simply because it collected so much cash on its IPO. It's on the balance sheet, it can use it to cover its cash needs in the near future. But the risk hasn't gone away, at least in my view. Now, you could disagree. Maybe you think there's no chance of failure given where Zomato is now. Maybe you think the risk of failure is much higher. So those are your choices, and your choices are going to give you a valuation. Now, as you make these choices, remember you're telling a business story, not a fairy tale. And this is where the 3-part test that I talked about comes in. Is it possible? Is it plausible? Is it probable? If something is probable, it's easy to bring in numbers because it's already in the data, in the financials. If it's plausible, you can bring it in through a growth rate and expectations for the future. If it's possible, then we're talking about that real option component. Now, I think the food delivery business is clearly probable. Zomato is already successful in that business. The grocery delivery business, I think, is clearly plausible. Now, could Zomato do other things? Perhaps with the platform, I don't know, but that could be the real options component. So as you tell your story, you got to think about, are you telling a fairy tale? Are you telling a plausible story? I'll give you an example of an implausible story. As you navigate your way through these choices, if you have strong priors, you're going to be tempted to do something that many people do. So you're an optimist on Zomato. You're going to go with the most optimistic, most upbeat choices in each variable. The biggest market, the highest market share, the highest margin, the lowest cost of capital, very low reinvestment. And if you're very negative about the company, you don't have strong positive priors, you hate the company, then you're going to give it the smallest market, the lowest market share, the lowest margin, not the highest margin, and the lowest cost of capital. So replace the highest with the lowest. Well, the former is called a best case valuation and the latter is called a worst case valuation. I've never understood why people do those. Because here's what you're going to find. In your best case, your company is worth a lot of money. In your worst case, it's worth nothing. Oh, how good is that conclusion for you? In fact, when I put in the best case assumptions in my valuation, I came up with a value for Zomato of 423 rupees. And before you get too excited, that's a fairy tale. Because if I choose the biggest market, which would include grocery delivery, and give it a 25% slice of revenues, that's not a business story, that's a fairy tale. That's why I don't spend my time with best case and worst case valuations. But there are valuations stories that are bigger stories and smaller stories. Here I picked a subset of stories. So for instance, delivery juggernaut basically means that Zomato goes after both the food and the grocery delivery market, the 5 trillion. I give it a market share of 40%. I give it the 25% revenue slice. If it's a juggernaut, I give it the maximum slice, the highest margin. I give it the cost of capital at the 25th percentile. The first decile I think is overreaching. And I come up with a value of 150 rupees. So you know what? If you bought Zomato at 120 and you want to use a valuation justification, that's the only story that flies. If I make your delivery start, big market, but I lower the revenue slice to reflect the fact that grocery revenue slices are smaller and the margins to a more sustainable 35%, my value drops to 93 rupees. If I bring in competition, which will lower the slice of revenues, especially if you look at the collective market, and give them a median company's cost of capital, the value drops to 62. If you look at the range of values, I could get a value of 150 or 17, but those are at the outer ends of plausibility. They're plausible, but I'm really, really pushing the limits of what's plausible. The probable values here are tightly bunched up between about 25 to 60 rupees per share. At least as an investor, when I look at those numbers, that's what I see. Now, of course, if you look at the market, the demand and supply setting Zomato's prices, and you might say, look, if enough buyers line up to buy Zomato shares, who cares about value? You know what? I don't disagree with you. It goes back to a contrast I drew between value and price and between investing and trading. So here's how I'd state what I've seen looking at Zomato. As an investor, I'm having a really tough time finding a pathway to get to value per share that justifies paying 140 rupees. That seems, now there's one pathway and it's really too much of a reach for me. That may of course reflect my failure of imagination. Maybe there are things that Zomato can do that I haven't factored in that you can bring in. But go ahead and bring them in. See if you can get a value that justifies the price. As a trader though, the way you think through this process gets very different. You frankly don't care what Zomato is worth or what the value per share is. It's all about mood and momentum. And whether you make money on Zomato will depend on how you play that game. And guess what? The tools you need for that game are not in my discounted cash flow valuation. They might be in charts and technical analysis, engaging who's buying and selling. I wish I could give you those tools, but I'm not a trader. I've never been very good at it. But if you choose to trade, remember, you are riding the momentum tiger. If you know when to get on and when to get off, you can make lots of money. But if you don't, that momentum will eat you up. Thank you very much for listening to me, and I hope you found this session useful. Take care.